Welcome
Hi,
back,
Ross.
everyone. This is Radio Free Market, and I am your host, Michael McKay. And we're talking today with Dr. Mark Thornton and Professor Patrick Barron, and we're talking about the boom and the bust cycle. And just before the break, Pat brought out this point on an economist by the name of Fisher that was very famous in the late 1920s and early 1930s. And Mark, I'd like you to tell a little bit more of that story and how he also got it wrong.
Well, Irving Fisher is the great American economist. He was the leading economist of his time, and he remains the sort of godfather of macroeconomics and of monetary policy to this day. And he recommended a policy whereby the central bank would try to stabilize the U.S. dollar, the value of its purchasing power, which sounds all fine and good. But basically what that did was it helped create the boom of the 1920s. And so as we go into 1929, Fisher is regularly commenting in newspapers such as the New York Times about how great everything is and how his monetary policy that he helped design is creating this, what he called a perpetual prosperity, just weeks before the stock market crash.
Kind of like what happened with both Mr. Bernanke and the other significant talking heads in our government about our own situation in 2007 and 2008.
Yes, well, this is consistent throughout the 20th century and into this 21st century, is that when you get this boom phase in the economy, or the new era of the 1920s, you get this boom phase and you hear the leading economists will come up forth with these pronouncements of how they've killed off the business cycle, how the business cycle is a thing of the past. And this occurred in the late 1960s before the stagflation of the 1970s. It occurred during the tech stock bubble, and it occurred during the housing bubble where, Greenspan and Bernanke as leaders at the Fed said, everything's great. We've fixed the system. We've got it regulated to the point where everything is just great. And Fisher really stands out in this regard because he created this whole system, and his system created the boom, and he thought everything was great. And so on the eve of the stock market crisis, he denied the existence of a bubble. He denied the existence of a possibility of a crash in the stock market. He said that we were on the edge of perpetual prosperity in the American economy, and that in basically claiming credit for everything that was occurring in the economy. And this is, again, just a few weeks before the crash in the stock market in 1929. And he continued to deny that this stock market crash, as it was occurring in 29 and 30, that it was real. And he said, that stocks have now fallen to its foundation level and things are only going to go up from here. Well, they continued to go down. And so if you followed Fisher's advice and stayed in the stock market, you would have lost 95% of everything you owned, just as Irving Fisher himself lost everything he owned. He was a very wealthy man. He lost everything. His wife came from money. They lost all of that. And even Yale University, its endowment, lost money following Irving Fisher's advice. And, of course, a lot of other people lost money following Irving Fisher's advice. It was a total disaster. It was a total slam. He should have been, his economics should have been questioned and discarded. But instead, it's maintained its status. And many of the leading economists of today look back and say, no, he was really, the sort of the godfather of what modern macroeconomics is all about, which is true, but it has so many faults in it that it really needs to be seriously questioned, and I think it should be discarded, but it still has this legitimacy because I think, hearkening back to what Michael said earlier, that these are all government-supported economists. They're either at state university or supported by state funds of one sort or another, and so they want to continue this masquerade that the central bank is our savior rather than as the source of the boom-bust cycle.
Mark, Pat again. Didn't Arthur Occam during Lyndon Johnson's administration, he was on Lyndon Johnson's Council of Economic Advisors, didn't he give a lot of the same happy talk right before the stock market took a big nosedive?
Oh, yeah. The 1960s were another period of boom, and at this point, the Keynesian economist, who developed from the work of John Maynard Keynes during the Great Depression, this new generation of macroeconomists had come in and had, come into Washington. They were in positions of policy making. Arthur Occam was a great example. He was the chairman of the President's Council of Economic Advisors, and, the 1960s were this boom phase. And he said basically that the business cycle was dead, that this new generation had developed tools to stabilize the economy, and that they could continue to stabilize the economy, going into the future. Well, it just so happens that he published a book making all of these proclamations the same month as the economy went into recession in the late 1960s. And, where he was saying everything is good and it's going to continue that way, well, as soon as his book was published, everything got bad and continued to be bad throughout the 1970s. We had
there was almost a 16-year period from 1966 to 1982 that the stock market literally went nowhere except down and then back up and then back down again.
Yes, it recovered its nominal value. If you look at 1969, you would have to wait to 1982 to get your same money out of that in terms of the stock market. But in real terms, if you adjust for inflation, you would have, if you had bought and hold that whole time, you still would have lost 50% of your real purchasing power. So this was an incredibly difficult decade where unemployment rates remained above average throughout that 12-year period, hit double digits in the early 1980s, and where you had a tremendous amount of inflation throughout that entire period, well above any rates that, CPI-type rates that we're experiencing today. The price inflation was significant, and so it was a period of tremendous degeneration in the American economy, and it took a long time to clear out all of the bad investments that were made during the 1960s. And of course, they went through the similar process that Hoover went through, where they tried to, bail out people. They tried to create low interest rates. They tried, deficit spending, public works projects, all sorts of these,
wage and price controls.
Oh yeah, wage and price controls, going off the gold standard. I mean, these were very significant moves of government remedy for the for the business cycle. But what the government remedies actually do is keep the infection of malinvestments going in the economy. And so you end up with 12 years of economic degeneration, whereas if you allow the market to work, the marketplace can clear up all of the errors of the boom in a very short period of bust. But what Americans have been doing, specifically during the 1970s, is try to fight the bust with government remedies, and it just doesn't work.